So what's in the news today? More inflation. So we're getting more inflation news out of the U.S., PPI, record inflation levels in the UK, and across the majors, what we're seeing a lot of is this channeling behavior since about first quarter of this year, if not a little bit earlier. So just depending on what you look at, there's a lot of channels going on. This can be tough. As easy as this seems when we're looking at textbooks and such to trade, this can be tough for a lot of traders. And I know that for a couple of reasons. Number one, I can kind of see what trader activity looks like on the dealer side, as well as just what's the buzz, what's the traffic like, how interested are traders in being involved in the market. And right now, we're continuing to see a bit of a decline as traders struggle quite a bit. Here's another example of the same thing. This is on the British pound to the dollar. So the pound dollar, same type of situation. I think one of the reasons why traders who try to take advantage of the trend struggle in a market like this is they become very myopic, or they develop a kind of tunnel vision amongst the majors or whatever their favorite currency pair is. I see a lot of emails and traffic in one forum or another about the fact that they may even concentrate on just a single pair, the euro US dollar as an example. So when it begins to act in a way that they aren't very good at dealing with, so a channel, for example, then they start to really suffer because they haven't looked outside of their own trading specialty. So what I wanted to do today was just propose three different ideas that look like current opportunities right now, and if nothing else, to discuss them in the context of these are opportunities that will appear and play out on a regular basis the same way that opportunities appear and play out on the majors. And when there's nothing happening on across the two or three majors that a lot of traders will concentrate on, there are other places to go. So let's take a look at the first example. This is the euro pound, and despite the fact that most traders are familiar with this cross, it's not that exotic. It's just the euro against the pound. Most traders are familiar with it, and yet very light trading traffic. So not a lot of trading going on here, and yet it's very interesting. So you'll notice that this one has a much more clear trading pattern here. We've got a consolidation, so we do have the same kind of consolidation that we've been experiencing on a lot of the majors, but we're creeping up on a potential breakout. So we've had a little bit of a fake out here earlier in June. You can see here, and then we're closing in on this upper resistance level. Well, the market, if you can imagine it having feelings, does not like being in a tighter and tighter range, and eventually a breakout will occur one direction or the other. Now the question obviously is which direction, but usually we err on the side of the previous trend. So in this case, with the bad news coming out in the UK, meaning inflation seems to be much more problematic for them than it is in the eurozone, we could see a breakout to the upside. Now, interestingly, the euro pound, if you're not familiar with trading it, the trading range here with this consolidation pattern isn't really that big, a couple of hundred pips, but the advantage here is that its pip value is actually quite high. So on a $100,000 or on a 100,000 unit contract, the pip value in U.S. dollars is worth about $19, almost $20, or $2 for a mini contract. So despite the magnitude of the moves, the pip value is actually quite high. So it works out to be quite an attractive opportunity from a volatility perspective. So a breakout here to the upside is certainly the direction that I'm biased, and might be a nice opportunity to take advantage of another move to the upside. We could look at that. We could start to forecast where that might go in a couple of ways. One of the methods that I use all the time is I'll apply a Fibonacci analysis from the top to the bottom of the widest part of that particular channel, so between the support and resistance bounces, and that'll give me some Fibonacci projection to the upside, which right now puts me all the way up at 8,300. So it could be a nice opportunity, 400 pips potential to the upside if we get that breakout that we're looking for. But once again, just looking out across, not to an exotic of a cross, but to a pair that's not very actively traded, because traders are spending a lot more time concentrating on some of the more well-known majors, such as the euro or the pound crossed with the dollar. Well, that inflation news may create a disruptive static across some of the majors, including the dollar, the euro, and the pound, as those central banks try to deal with that. And largely, they're stuck in this tug of war across those major pairs that are keeping them within fairly tight ranges. Well, inflation oftentimes equals speculation that that interest rates are going to go up, and I think at this point it's a very safe assumption that central banks like the Fed, for example, are going to raise rates. Well, we're not getting that same kind of implication, and that speculation is being spread not only to the U.S. dollar, but even the pound, the euro. As we start anticipating higher interest rates, is going to keep them bound up in this tug of war between each other. Whereas we don't have that same kind of impact on the dollar yen, which is not a pair that I see people talking about as much as they had in the recent past before the price shocks of fourth quarter of 2007. So while still a very popular pair and one of the majors, a lot of traders have been a little bit scared off. But I don't know if you've noticed, but since the breakout in May, we've had a very nice rise of another 400 pips to the upside. So we're creeping up right against a resistance level. There's been support twice here recently in fourth quarter and very beginning of first quarter in 2008. Resistance here in February. We're approaching that level again. A break here, I think, legitimately could send us into the 117 range. Now, I say that for a couple of reasons. Not only was it a significant level of support last year, but if we apply a Fibonacci analysis to this recent decline that really turned into a V reversal down here in March, it puts our 161.8% retracement level at about 116.50. So that's not a bad price target should the market break up above this level or up above this 100% retracement level where we're stuck right now. But in light of the trend or the forecasted trend of interest rates, we could see that level again, which would be from a certain perspective, almost a complete reversal of the correction that we got because of the credit market price shocks. Safest bet in the market these days seems to be higher oil prices. I have the continuous crude oil contract here. This is the futures contract. And I'm just using it to illustrate a point. You'll notice that the market is consolidating a very tight range. The previous trend is positive and very dramatic, so we would be a bias to the upside. We're going to see oil prices at 150. Do you have the ability to trade oil? Maybe, maybe not. But there are other ways to take advantage of a breakout in oil to the upside, including looking at some of the more exotic pairs in the forex. So let me show you an example. This is a pair that I talk about once in a while, the dollar Mexican peso, which prior to some of the rise that we've seen in oil prices beyond anybody's expectation here, first quarter and fourth quarter of last year, had been stuck in a significant channel. It was great to trade because the channel was really, really wide, unlike some of the channels we're seeing on the majors right now. So you'll notice it broke out below one of these channels here in March and April of this year and has since been trending down. Has been pretty reliable in hitting price targets based on some of these retracements, which we've recently had one. So we've had a little correction here in early June, and then another dramatic decline as oil prices kind of shot up, and we got big surprises, including the high prices yesterday. Well, using a similar price forecasting technique, we can look at each one of these corrections, such as the one that occurred in April and May, attach a Fibonacci to the top and bottom of it, and it gives us a price projection. So down here, the 161.8 is where we would expect a consolidation to occur, which in fact did here in June. We can do the same thing here just after the breakout from the big channel earlier this year. It puts the 161 down here at where the market was consolidating in April and May. So pretty reliable way to look for a price projection on a breakout. If we do that same thing right now with the breakout or with the correction that's occurred here recently, we can enlarge the chart here a little bit. That puts us down here about 1,000 pips below at 1020. Now, by the way, keep in mind that like the pip value on the euro pound, which is a little bit different than you might expect across some of the majors. Well, the dollar Mexican peso is very different because it's of course 1020 to the peso. Or I mean pesos to the dollar, that is. So that basically cuts the pip value by a tenth to 1/10 of a normal pip value. So you're looking at about a dollar per pip on a regular $100,000 lot in this case, so a 100,000 unit lot in this case, or